Hello friends, in this video we are going to study about accounting concepts and conventions. So accounting concepts and conventions are the theoretical framework that we have to observe and understand in order to do the accounting the way it is. So we are going to discuss the following accounting concepts today. The concept of the business entity concept, money measurement concept, going concern concept, cost concept, dual aspect concept, accounting period concept, matching concept, and realization concept. Besides this, we are also going to discuss about some accounting conventions like conventions of full disclosure, convention of consistency, convention of conservatism, and convention of materiality. So let's begin. So let's first study about accounting concepts. So the first and foremost accounting concept that we are going to study is business entity concept, and what this concept says is business has a separate identity of its own, different from its owner. So you must have observed in my earlier videos as well that whenever we are doing accounting, we have to think of ourselves as the business and not as the owner of the business. The same thing has been mentioned here. So only transactions relating to business are recorded in books of accounts. So the personal transactions which relate to the owner of the business are not recorded in the books of account. And owners of business is also treated as a creditor. So this way, since a business treats the owner of the business as a third person, because it says that it has its own identity, so any amount taken from the owner of the business, known as capital, is treated as a liability, and the proprietor is treated as a credit. Second concept is money measurement concept. So this concept simply says that only monetary transactions can be recorded in books of accounts, or we can also say it other way around, that non-monetary transactions cannot be recorded in books of accounts. So any non-financial or non-monetary transactions cannot be recorded in accounting. Going concern concept. This concept says that it is assumed that the business will go on or continue forever. So what it says that we assume that the business will have a long life which will extend for foreseeable future, and the business has no intention of shutting down or limiting or curtailing its scale of operation. Cost concept. Cost concept says that the assets are recorded at a cost paid for it. So what it means that, let's say, if we purchase an asset which is selling in the market for rupees 10 lakh, and somehow we are able to purchase it for 8 lakh after getting some discount, so we will record it at 10 lakh. That is, sorry, we will record it at 8 lakh. That is the amount actually paid for it, and not at its market price. So the only way there will be a change in value of asset from cost will be by way of depreciation. So reduction in value of asset is due to depreciation. So generally we will not change the cost of a thing, okay, except for depreciation. Dual aspect concept. This concept says that every transaction has two aspects, a debit and a credit, and every transaction affects both assets and liability sides equally, that, or in a way that assets and liability sides is always equal. So every transaction has two aspects. Assets always equals liabilities, and debits always equal creditors for any given transaction. Accounting period concept. This concept says that since a business will go on forever, as we have assumed in going concern assumption, so its life is divided into fixed period. So generally it will be of 12 months, and in order to find out profit and loss for that period, final accounts are prepared. So what this concept says is that since the life of a business is very long, and we cannot wait to know the profit and loss made by the business till its liquidation or till its end, what we do is we artificially split its life into smaller periods. Let's say 12 months. Generally 12 months is followed, so that we can find out whether the business is actually making any profit or not. So due to this principle, every year we prepare final accounts to find out the figure of profit or loss earned or made during that year. Another concept is matching concept. What matching concept says is revenues and expenditure should relate to the same period. So what it says that it also borrows from the previous concept of accounting period, that whenever we are doing counting, we are interested in finding the profit to that particular year only. So in order to do that, we have to take revenues for that period only, and from those revenue we have to deduct expenditure relating to the same period. So if we do not do this, we will get wrong figure of profit, because if we take revenues from different periods and expenditure from different period, the resulting figure of profit or loss will make no sense. So according to this principle, it results in prepaid outstanding expenses or income. Let's say if we have paid certain expenditure, the benefit of which will also extend to future years, so we need to exclude that part from expenditure. So such adjustments are made due to this principle, and we can see its application while preparing financial statements or final accounts. Realization concept. This concept is also known as revenue recognition concept, and it's talk about when we should realize or accept that revenue has been earned. So revenue is to be recorded only when there is no doubt about their realization. So it says that when there is complete certainty that revenue will be realized, it should be recorded only then. If there is any doubt about realization of revenue, and in such a situation, revenue should not be realized or recorded. So now we are done with the accounting concepts. Now let's go to accounting conventions. So the first convention is convention of full disclosure. What this says is accounting statements should disclose complete information, and no important information should be concealed or omitted. So what it simply says that, as we have studied in the definition of accounting, that ultimately accounting information is used by users of accounting information to make informed decisions. So while preparing financial statements, we should ensure that accounting statements disclose all the relevant and complete information, and no important information should be concealed or omitted, so that informed decisions can be taken by the users of accounting information. The next convention is convention of consistency. What it says that it so happens that while doing accounting, we face that we have alternative policies, methods and estimates that we can use. So it becomes essential that whatever method, policy or estimate we take, we follow it consistently year over year, so that the final results are comparable. So same accounting policies, methods, estimates, etc. to be used every year. So as far as possible, switching from one method to another to be avoided. So consistency, as it means we have to choose the same methods year and year after, so that when we comparing performance of different years, we can reach a relevant result which is not affected by change in accounting policies or methods or estimates. Another convention is convention of conservatism. So this is also known as prudence. So what a conservative or prudent person does is he anticipates no profit but provides for all probable losses. So this, in accounting, we also follow the approach of conservatism or prudence, that we anticipate no profit but we provide for all probable losses. So this results in making of provisions for losses, for example provisions for doubtful debts, and valuing stocks at lower of cost, price or realizable value, and other things. Now is the convention of materiality. So what it says, that material items should be considered while preparing financial statements. So it says only relevant and important, also known as material, information is to be considered. Unimportant items can be left out or merged with other items, and all material information should be disclosed. So let's say, for an example, if a business purchases a machinery, it has to show that machinery as a separate item because it is a material item. But let's say if a business purchases a calculator, which will also have a useful life that will extend beyond 1 year, and which technically also falls under the definition of fixed asset, but the value of that asset is so meager that it would be unimportant or useless to show it as a separate item. So what we do is we merge it with other items, or even we simply treat it as an expenditure and write it off in the very year in which it is incurred. So in this video we talked about accounting concepts and accounting conventions which are necessary to be understood in order to do accounting. So though these concepts answer many questions while doing accounting, that why we are following a particular type of treatment for certain items. So please, thanks for watching. Please like, subscribe and share. Do not forget to press the notification bell so that whenever a new video comes up you see it first. So I am CA Yogesh Sethi. We will meet you in future video. So thanks for now. Bye.